search was an idea. It wasn't an asset class. There were not enough data points out there yet to make for an asset class that a highly academic institutional investor could really analyze and think about putting money into.
Search Party is sponsored by Boulay, Kilpatrick Townsend and Stockton, and Oberle Risk Strategies. The lead sponsor is NCL Partners.
Hello and welcome to Search Party. I'm David Snow, your host. And today we're joined by Susan Pohlmeyer, co-founder and partner of Futaleufu Partners. Susan, how are you doing today? Thank you for joining Search Party.
I'm good. Yeah, thank you for having me.
You're based in the Bay Area?
Yes, I'm in the Bay Area, and my partners are spread across time zones. So we cover the whole country, but I am in the Bay Area, and that's kind of the firm's center of gravity.
Excellent. Well, there's a bunch of stuff I would like to talk to you about because you've got a really interesting background and expertise. You are with Futaleufu Partners. You're a co-founder, which is in the entrepreneurship-through-acquisition world. But you also have a very interesting background having worked for the Stanford Management Company, which of course is a major and very prestigious institutional investor. And so I am interested in how that experience informs your understanding of ETA as an asset class, distinct from perhaps other asset classes. And so that'll be a great conversation. Why don't we just start at the beginning with what you are doing now? Give us an overview of what Futaleufu Partners is.
Sure. So Futaleufu Partners is a firm that invests exclusively in search funds. Most of the listeners are probably familiar with search funds, but basically we invest in who we believe to be highly talented, high potential entrepreneurs in a search to go find a company to buy. And then usually we invest in the company that they find as one of a group of investors. We are investors, but we think of ourselves very much as investor mentors because a lot of our heavy lifting really comes after closing on that transaction of buying the company. We're very focused on post-closing operational mentorship. So things like we have an 18-month leadership academy, which is you can kind of think of as a boot camp for training new CEOs and helping them get up the management curve quicker. My partners and I sit on boards and try to be very active there in as many boards as we have bandwidth for. We have a dedicated selling coach when our companies are looking to sell that basically pairs an entrepreneur with an experienced investment banker to kind of coach them through the process and help ensure they're not leaving money on the table. And early financial accounting and controls support is also a program we do. So even though we're investors, I'd say we probably spend more time on the mentorship side of this. And that's pretty typical for search, is really high-touch, mentorship-oriented investing.
Excellent. And of course, your co-founder is David Dodson. He is a veteran of ETA. He's been around since the very beginning, right? That's
right. He, depending on how you count it, I think he was the second official search fund in search fund history. He started as a case writer at the Stanford Graduate School of Business after he graduated. And he was a case writer for Irv Grousbeck, who I think everyone knows who that is. The first case he wrote on was of the very first search fund, or the first kind of recorded instance of investors, in this case Irv, really anchoring this pair of search entrepreneurs who went out and looked and bought a company. And when David was writing about it, he said, Irv, how do I do this? This is what I want to do. Irv and a collection of other investors that people would know well by name backed him then in his search, and the rest is history.
Excellent. Well, let's start with you and your journey into ETA. Let's go all the way back. Were you raised in an entrepreneurial household? How did you get the entrepreneurial bug?
My dad was definitely an inspiration for me. Second generation American, first in his family to go to college, which was a big deal. He grew up in Detroit, and so almost pretty much all of my family they had a long tradition of working in the auto industry, and he just decided he wanted to do something different. He graduated from Michigan State with a degree in civil engineering. And from there, he just said yes to every interesting opportunity that came his way. He worked for General Electric, a big corporation, for most of his career, and did a lot of new and interesting things through the opportunities created for him by GE. And so while he wasn't an entrepreneur per se, he really inspired me to blaze my own trail, chart my own path, if you will.
When did you first hear about entrepreneurship through acquisition?
I worked at the Stanford Management Company prior to going to business school. We talked a little bit about search funds there, so I kind of knew what they were. But I didn't really learn about the model until I went to Stanford for business school. And I took the class. And my story of how I found my way into ETA is familiar. It's a familiar story. It's how many search entrepreneurs find their way into ETA. I basically went to business school knowing I wanted to run something, and I didn't know what that would look like. I just said, I want to run something. I've been an investor my whole career. I want to be an operator and run something. I don't know how that's going to look. I took the class on ETA, and you'll hear this from so many entrepreneurs, but it just clicked. I said, this is what I want to do. I want to take something, and build upon the success it's had. I wasn't really intrigued by the 0 to 1 problem. It wasn't so much that I needed to create something new. I was really drawn to the idea of taking something that was proven, established, like something that I could evaluate with my investor mind as a great business, learn from someone who blazed the trail before me, the founder or the seller in that case, and build upon basically the legacy that they had built and just continue to grow that business. And that just sounded so appealing to me. So I thought I was going to do a search. Obviously, did not do that. So when I ended up connecting with David Dodson, who happened to, along with Peter Kelly, teach the search fund class that I had taken, I interviewed for the case writing position at Stanford. And he called me after the interview and said, hey, look, I know that case writing is interesting to you, but something that might be interesting is I invest my own capital in search funds. Would you like to join me for a year, help me out? I have some friends and family that are interested in investing alongside me, so I need someone to help me kind of do that and just professionalize my own processes a little bit. So I said, yes, sign me up. I still got to be a part-time case writer and work on the search fund study. And then we ended up finding ourselves coming up with all these new ideas of how we could support entrepreneurs. Now that there were 2 of us and it wasn't just David on his own, we started building out content. And before we knew it, we were building a firm ourselves. And so that's how I ended up here, where we're now on Fund 5.
Let's talk about Stanford Management Company, where you spent 4 years before entering the ETA world. Just for people who are less aware of Stanford Management Company and sort of where it fits into the universe of institutional investors, give us an overview.
Sure. So Stanford Management Company manages the financial assets of the university. It's about a little under $50 billion. Last time I checked the publicly published numbers, it pays out about $2 billion a year, which accounts for about 1/5 of the university's operating budget. It's kind of amazing that it's only 1/5, but the bottom line is it's a huge source of capital for the university annually. And it's a fund of funds model for the most part, but basically they really focus on fund manager selection and portfolio management. And that's how I really spent most of my time there. So I started in the portfolio management group, which looked across asset classes and thought about things like how to allocate capital across different asset classes. And then I gradually moved my way into the private equity group, specifically because I was really interested in how companies create value. And that was very much, again, a manager selection role. And so the vast majority of my time was spent interviewing and evaluating prospective fund managers, as well as evaluating and analyzing our existing portfolio performance. But at the time, there was just an enormous number of investments to oversee and manage. And so when you think about the size of this endowment, it is hard to put that much money to work. I focused a lot on lower middle market private equity, but lower middle market in the world of big endowments like Stanford is, maybe $1 billion fund. So order of magnitude different from what we'd be talking about in search world. Search was an idea. It wasn't an asset class. There were not enough data points out there yet to make for an asset class that a highly academic institutional investor could really analyze and think about putting money into. So we didn't really talk about it as a serious potential investment, but we were kind of intrigued by the idea of it. The way that endowments sometimes think about accessing these really little or emerging asset classes or emerging managers even is to maybe create a basket of investments and invest in a few of them. And we used to do that for really small VC, like budding seed funds, for instance, that we thought had a lot of promise. But the ecosystem of search wasn't even that big yet. So there was no serious talk of investing in them at the time.
Many of the investors in the ETA world are individuals who themselves bought, improved, and sold a lower middle market company, and now they're turning around and backing other searchers. That's not necessarily an asset class if you define it strictly. But in your mind, what is the threshold past which a collection of investors, a community of investors, starts to perhaps standardize things, starts to get to a level of professionalism, of institutionalization, that you can call it an asset class?
That's a good question. If I think about how the search fund asset class got professionalized, first came some investors who actually wanted to have a fund. There have been individual search investors for much longer than there have been funds. When the funds came along, with that came professionals from the investing space as well as just former search operators, and kind of had some sense of what it would need to look like in order to attract outside capital into their funds. So there have been a couple kind of parallel processes that have matured at different points in the evolution of the asset class. One thing is just how diligence on these companies is done. It used to be what investors like my partner David would call the Wild West of investing, in that really no one kind of knew what they were doing. It was just like you identified what you thought was a pretty good business. You put a deal together and across the kitchen table from the seller, and you got something done, and then you figured out what you actually bought. Now, fast forward to today, there are firms that have dedicated practices to search funds in the accounting world. You've got accounting due diligence professionals from accounting firms that actually focus on that. There are law firms that have their own search practices, and there are also lenders that have dedicated search practices. And so just the way things are done has become more standardized and more thorough, and it's harder to miss just really basic, obvious misses. Interestingly, it hasn't changed the returns a lot, but it has made it feel more comfortable for more, I would say, institution-like investors. There still isn't really much institutional capital in the space. Our fund and other funds that I know well, it's primarily high net worth individuals and family offices. But these are still very knowledgeable investors who understand the ins and outs of asset classes and asset class performance and so forth, who wouldn't have been comfortable with this complete Wild West that Irv Grousbeck was originally investing in, even though his return track record is phenomenal.
Yeah, you typically don't want to go to an institutional investor and ask if they want to invest in the Wild West. They want the West to be tamed before they invest in it. As you mentioned, you're essentially evaluating the prospects of a manager, of a searcher, who is going to, one, go find a business, and then two, hopefully run it. So how have you sort of professionalized and turned that into a repeatable process?
So we have a very specific set of criteria we evaluate potential entrepreneurs on. What it all centers on is their ability to be coached into being a great CEO. It's not that they've already been a CEO, they've already run something. It's that they kind of have these key characteristics that we believe will make them a good CEO. Well, I mentioned coachability. That's huge. This is so critical because almost everyone we back has not run a business before. They might have run a business division, they might have run a division in the military unit, but they haven't actually been a CEO before. And so coachability really breaks down into a couple things. It's humility, it's willingness to seek and take advice. It's kind of a desire to shine light on your blind spots rather than cover them up. And then the other piece is just a bias towards action. So we call this the GSD, or get shit done factor. It's just people who run through walls to get things done. We have found people they're very coachable, they're very self-aware, all these things. They want the coaching, but they just can't make a decision. And that's a tough thing.
It's so interesting because a big part of the population of at least traditional ETA search are people who have graduated from the best business schools, who come from often a very pedigreed background. They have probably had good grades their entire life and had great jobs. And yet your firm and a number of other firms in the ETA space are not necessarily looking for the smartest guy in the room or someone with some sort of impeccable pedigree, you need a bit more of the soft skills. And what I'm told is that sometimes you come across someone who's incredibly intelligent who cannot connect with a team of, HVAC engineers and run a business successfully.
Yeah. Yeah, definitely agree. Ability to connect with people. I mean, especially at this size of the market, it is all about managing people and building teams and managing teams. When we're coaching them in their search, we look at whether that business just feels like, oh gosh, it's just not going to be a good fit for that person. So sometimes, hey, they might not run an HVAC business well, but they might be really great at running a software business, for instance. Sometimes there is a fit element too that we have to coach them through so that they find the right business for them.
You mentioned at Stanford, it was kind of hard for your endowment to write checks that were small because you end up doing the same amount of work for an investment that really might not move the needle in the overall portfolio.
Search is all about very consistently protecting capital and getting really solid returns in kind of the 2 to 5x range, and just doing that over and over and over again. And that generates some really compelling returns. But it's hard to make these little bets if you're not going to get a really disproportionate return on them from the perspective of an entity like the Stanford Endowment. So yes, putting all these small checks to work doesn't make a lot of sense. But the other thing is that the constraint in the search world is the number of search entrepreneurs that are doing this at any given time that an investor can support. There are a couple things going on there. One is there are only so many people that sign up to do this every year. Like there's not an unlimited number of search entrepreneurs out there. And the second piece is that the investors themselves have to commit to a very high touch mentorship oriented model in order for this to work. And I think most of the really established search investors in that space truly embrace that because they know the returns aren't there. That's one leg of the stool. The 3 legs of the stool that make the search model work are a great industry and company. Second is a talented entrepreneur who can be a great CEO. And the third is investor mentors. So if you take away that mentorship aspect, you don't have a stable stool to generate these great returns. For any individual investment firm like ours that focuses on search, you can't really stretch that model too much because mentorship is just fundamentally not scalable. Now, we have programs in place and content that's repeatable and stuff that really has supported our growth to this point, but we are never going to have $1 billion fund.
In investing, the less efficient the market, the higher the chance that you might be able to realize some sort of arbitrage and a good return. The smaller you get in the lower middle market, typically the less efficient it becomes. And yet, what have you seen across the markets that you cover by way of efficiency? Are they starting to get sort of inundated with lots of buyers and intermediaries and even knowledge that maybe some of the inefficiencies that were looked upon favorably are starting to get arbitraged out?
Not really. There is more capital flowing into the search world, but the inefficiencies are primarily created by just illiquid markets. And when you look at these really small companies, private companies, there's really no market for them. There might be a sale process that gives you a couple of validation points, but there's this huge value creation arbitrage often between the company that is still owned and run by the original founder, who is often nearing retirement or feels that their company has outgrown them. In many cases, they were never planning to grow a business, really. They just kind of built something small and it grew and it was in a good industry. And so there's this arbitrage opportunity, if you want to call it that, in just having someone new come in with more capital, more levers to pull. There weren't the resources in place until there was that turnover in leadership. And we continue to see that in the companies we buy today. So, is there a little more competition for these companies, and does it drive up the price? And in some industries, we see that, yes. We recently were having a conversation with on one of our quarterly LP calls about the prices we've been paying for businesses. And it's actually stayed pretty stable throughout the last 11 years. So yes, there are some areas that get hot and we try to avoid those. Overall purchase prices haven't changed on average for us a lot. We have the luxury of being able to hold these for the long haul. And we do. We don't have a prescribed exit horizon on these businesses, and that helps a lot.
I am hearing from a number of people in the ETA world that you're seeing an increase in investment activity from what is nominally ETA, but into more almost private equity style roll-up situations where the initial investment is actually the combination of a couple of companies. It might be a little bit bigger. They might involve more money. And so, of course, that's sort of getting out of not only the size range of traditional ETA, but the types of entrepreneurs that actually know how to do something like that. To what extent have you seen that sort of roll up, more private equity M&A style strategy coming into the asset class, and what are your thoughts about it?
Yeah. It seems that there are some investors that do more of that, and it's kind of what they specialize in. Maybe I can think of one group where the partners came from doing that themselves as search entrepreneurs. We are cautious because there's some operational complexity involved in basically not only running a business. Like, our model is to teach someone how to run a business well and help them run that business well and support them in that, grow it, exit. If your core thesis centers on M&A, then you're asking your CEO to also be a business development person out of the gate. It's basically two roles in one. Head of business development is a role itself, and they kind of usually, when they come into these companies, they end up playing both if it's a single searcher, and that is really hard. And a lot of people, I think, don't go in with their eyes wide open about that. We like to see that type of strategy executed by a team, ideally, so a pair of searchers. We also are just cautious about having the M&A be core to the thesis, meaning there's no part of the thesis that just buying the original investment itself could yield a great return on its own. Now, what we really like to do is invest in a company where M&A is one potential avenue for growth down the road. So it's not dependent upon executing a successful M&A strategy, but it's one key way that you might accelerate if you're doing well.
How often are you seeing these days a potential searcher come by to meet you, and that's their thesis? They say, I'm going to go do a roll-up. I'm going to roll up a certain industry. They're saying, from the get-go, I want to take these two companies, put them together, and have some money to invest further as it grows.
Yeah, there have always been a few every year, and we've invested in a few over the years. I'd say, yeah, I've seen an uptick in that. It hasn't been so meaningful that it feels like it's a large part of what we look at today, probably closer to 5% now that I think about it.
This is a little bit its own topic, but since I have you here, I definitely want to ask you. AI, one interesting way to look at AI as it applies to business is that everybody has access to AI, and so a small business, even of the size that ETA searchers go after, suddenly may be able to arm itself with knowledge and capabilities that perhaps it wouldn't have had in the ChatGPT era. How are you seeing AI being an opportunity for the kinds of lower middle market businesses that you back?
I think it's a huge opportunity for many, because what it does is it levels the playing field on technology, and it really shines a light on those who execute well. It kind of goes back to these sort of fundamental management building blocks, and we feel good about that because that's what we really focus on with our entrepreneurs. The way we look at AI in our portfolio and in future companies to invest in is, first of all, will they benefit? Will they be replaced or disrupted, or are they kind of in neutral territory? And fewer are in that zone where we can say they're really in neutral territory. Of the companies we look at, probably 2/3 of them at least, we're saying, oh, this could really benefit from AI, as opposed to the 1/3 where we're saying, oh, there's some risk that maybe AI will replace or heavily disrupt what they're doing. So we think there's an opportunity for good managers to really shine, because it becomes less about having the latest and greatest technology. Like you said, it's accessible to everyone now. We have yet to see that play out. We're still in the early innings, but it's obviously changing things fast.
What makes you feel bullish to be part of the ETA search world?
I guess what makes me excited is there is never a lack of just highly motivated, hungry, entrepreneurial young people out there that want to do this when they learn about it. It's exciting that, in a way, I know there are all sorts of worries out there that, oh, there's so much capital going into the space, the secret's out, returns are going to come down. But the way I see it is just search investing we've just made better in a lot of ways, with some, cautionary tales that have popped up over the years. Obviously, like The mentorship still has to be there. The hard work on the part of the investors still has to be there. But the entrepreneurs are still showing up. Like the people who want to do this are still showing up. And my favorite part of the job is supporting and helping develop these people and just playing this small role in their success. And so the fact that there are still people fundraising every year wanting to do this and asking us to be a part of it makes me very bullish that the future of search continues to be bright. As long as there are good entrepreneurs there, there are always going to be good companies to buy and run.
Excellent. Well, thank you so much, Susan Pohlmeyer, co-founder and partner at Futaleufu Partners. Thank you for sharing your ETA journey, your thoughts about ETA as an asset class, and just generally what you think the future looks like for this very vibrant community of investors and entrepreneurs. Hope we can have you back on Search Party again in the future.
Thank you for having me.
Search Party is sponsored by Boulay, Kilpatrick, Townsend & Stockton, and Oberly Risk Strategies. The lead sponsor is NCL Partners.